lot of people think the way you beat the market is you run up hard with a hard rising market and you sort of hang on the way down, and you've got to ride the highs and ride the lows. Defensive equity sort of said, look, there's a sub-segment of the market where you go down less when the market goes down. That's where you generate your excess returns, and you try and keep in touch on the way up. The goal is to go down half as much as the market when it goes down, and then it only goes up 80% on the upside.
A lot of advisors might think of banks as a classic defensive play.
Yeah.
Is that the case?
We've been doing it for 11 years now, and in that time the market's kind of doubled or more, and we're kind of handsomely ahead over that time. Being a financial planner is a lot of technical skills, but you're also a psychiatrist as well, right? Like the phone rings a lot more when the market goes down. When the market goes up, everyone's fine. And when it goes down, that's when things get hot. And what can you do to kind of make that an easier ride for you and your clients? What can you do to sort of soften that blow?
Capturing alpha isn't just about outperformance when the times are good. Today's fund manager has a different approach. He aims to generate his outperformance by only falling half as much as the market. Welcome to the world of defensive equities. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we're speaking to Hamish Fitzsimons, Chief Investment Officer of Australian Equities at AllianceBernstein, about the role that defensive equities can play in client portfolios and some of the common defensive traps that we should avoid. Ren, good to be with you.
Bryce, good to be with you. Excited for this one. Defensive equities. It may not be seen as the sexiest part of the equity fund manager spectrum.
Yep.
But let me tell you what is sexy. Outperforming the ASX 300 accumulation index since inception.
That is sexy.
That is sexy.
That is sexy. with a defensive tilt in there as well.
Yeah, with less volatility.
Yeah, wow.
So, yeah, look, I think defensive equities has a stigma is probably a hard word, but a certain perception around it. And we unpack this with Hamish a little bit more, that it's seen as slow growing, underperforming the market, purely reliant on dividends and not really driving any growth. But I think, as we said, like the fund that Hamish is running is outperforming the ASX 300 accumulation index. So there is growth there, but as he explains, like it's about trying to keep up with the market in the good times and shining in the bad times, which is an interesting conception. It's like not something I'd really ever thought about. Like my idea of outperformance is grow faster than the market. If the market's up 20%, I want to be up 25%.
Yeah.
Whereas he wants to be up, I guess, like 16%.
Yeah.
But then when the market's down 10%, he wants to only be down 5%.
Yeah.
Either way, the math still works.
It does work. And today we're going to dig into the strategy that Hamish and his team are deploying in the fund, some of the stocks that they're investing in, and then how you as advisors can think about implementing it into the portfolios of your clients.
We should say, we've said the fund a couple of times. For people who want to Google along at home, it's the AllianceBernstein Managed Volatility Equities Fund, MVE class active ETF. It is listed on CIBO. I'm sure it's available on most platforms that you're looking at as well. So that is the fund that we're talking about with Hamish today. We'll include a link in the show notes. But before we get into it, we want to say a massive thank you to our launch partners here at Basis Points, who've made this show possible and allowed us to produce it and keep it free for everyone. So a massive thank you to CIBO, to Milford, and Orbis Investments. But today, a particular thank you to CIBO.
Yeah. Did you know that Australia has more than one stock exchange? You might have traded on CIBO without even realizing it. With approximately 40% of all Australian ETF trading happening on CIBO, they understand the growing interest in ETFs among Australian investors. So you can check out more at cibo.com.
Now, before we get into it, a reminder for all advisors watching or listening, every episode of Basis Points is accredited by the Financial Advice Association of Australia for CPD points. To claim your points after watching or listening, click the link in the show notes, complete the quiz, and we will email you your certificate.
Alrighty, without further ado, Ren, let's jump into our conversation with Hamish. Well, Hamish, welcome to Basis Points.
Thank you for having me.
So let's set the scene. Defensive equities is what we're exploring today, which some would think that's a term that is an oxymoron. What exactly are defensive equities? How do they differ more broadly how do they differ to the broader market?
Right. Well, it's a good question. And look, defensiveness is a relative sense. We're not talking cash here, but within equities, I think a lot of people think the way you beat the market is you run up hard with a hard rising market and you sort of hang on the way down, and you've got to ride the highs and ride the lows. Defensive equity sort of said, look, there's a sub-segment of the market where you win on the downside, you go down less when the market goes down. That's where you generate your excess returns, and you try and keep in touch on the way up. It's not a free lunch. You don't beat both ways, but you beat it on the way down. So that's where defensive equities are. And it's just more of a steady profile, lower volatility. Some people just prefer that sort of probably lower excitement way of investing in equities, but you do actually beat the market over time. It's sort of one of the different ways of beating the market, but most people don't think of that as a way they could beat the market.
Yeah, I like that. I mean, any way you beat the market over time should be exciting.
Look, we've been doing it for 11 years now, right? And in that time, the market's kind of doubled or more, and we're kind of handsomely ahead, over that time. So it sort of shows, you can beat a rising market with defensive equities. It's picking your times. We're winning sometimes, we're losing sometimes. We're kind of gliding through the middle a bit more than going up and down.
Yeah. So to bring the concept to life, can you offer a couple of examples of companies that today would fit your definition of defensive equities?
Yeah, sure. I mean, look, one that springs to mind, sort of brand name I'm sure everyone knows, is Coles Supermarkets. Australians are not going to buy 50% more groceries next year. It's not going to sort of explode out of the box and have this dynamic growth story all of a sudden. But Australians will buy more groceries next year than they buy this year. And Coles will steadily grow their earnings over time. And when things get a bit tough, Coles will tend to do pretty well. So they tend to perform more when the market's pulling back. They might not be as exciting on the way up, but over time, they kind of cruise out and look pretty good. Medibank's another one a bit like that. Health costs go up every year. People want to pay a little bit more each year for health insurance. There's a few more Australians every year. Medibank insures a lot of them. Just steadily grows over time. Never going to pop out of the box with 30% earnings growth, but it's just going to steadily grow over time.
I noticed you didn't say Woolworths there. Not a fan, or?
Look, Woolworths is interesting. I think Woolworths, the core of what they do, they're having a tough time right now. I'm not going to get away.
Hamish, we should disclose I'm a former Coles employee. Bryce is a former Woolworths employee.
Right. Well,
an ongoing debate.
I don't know. That doesn't tell me who's for Coles or Woolies, by the way. I don't know which way you're coming at.
True.
But look, I think it's been a tough time, right? CEO turnover, Big W's tough. New Zealand's been tough. Coles has got their mojo back. They've turned over some people. Having said that, you look ahead. Woolies will get their act together, right? Like in a couple of years' time, they'll stabilise that. They will grow with Australia. They will grow with Australian supermarkets. They're winning online. That matters a lot. That's where all the growth is in supermarkets. So Woolies looks a bit tough right now, but I think sort of zoom out and play it forward, Woolies will grow their earnings over the next couple of years for sure, probably for the foreseeable future, right? I mean, Metcash is kind of not doing online. Aldi's kind of out of online. Online's where the game is. They're doing very well there.
Yeah. So we want to, I guess, take a step back in history and talk about the defensive equities story at AllianceBernstein, because the strategy really was driven by client demand, particularly post-GFC.
Yeah.
So can you tell us a bit about the history, what clients were asking for, and how that led to the creation of the fund you run today?
Yeah, sure thing. So if you sort of think back to the GFC, I mean, stocks halved, right? So 2008, 2009, and you can imagine the phone's ringing hot. People are, you're a financial planner or running a big super fund, people are ringing, what's going on? And the worst scenario that comes out of that is you sell at the bottom. And you go to cash and think, I'll time my entry back in. And it's so hard because you've got to make two perfect right decisions. You've got to perfectly get out at the right time, and then you've got to perfectly get in at the right time. Otherwise, you're leaving a lot of value on the table. And I can assure you, I can't get in one of those decisions right, let alone two, right? So the client came to us and said, look, how do we soften the downside so less people feel the stress and the need to sort of de-risk by going to cash? And that's when we did a lot of exploring and came up with this subset of stocks, which is the defensive equities. So when you go down, the goal is to go down half as much as the market when it goes down. So soften the blow on the downside. And then, I said no free lunch. It only goes up 80% on the upside. So you've got to give up something to get the protection. But that profile for a lot of customers is more palatable. I mean, this particular customer at the time was a large super fund. They had a demographic very skewed to older drawdown sort of clients. And in particular for them, they just needed they needed the cash flow. They needed to not get out of equities and kind of, because if they don't have time to recover, if they get the decision wrong when you're 70 and get out into cash,
Done.
Yeah, you haven't got 10 years to grow back into it. You need to sort of get that right and de-risk. So that was the genesis. And interestingly, we just found it's not just for people who are older who want to sort of protect their, a lot of people just prefer, as I say, the lower excitement way of investing, right? Like you get to the same place, but possibly feel better about it along the way, depending on the profile of the customer and their risk profile.
And so how has the strategy evolved since the GFC through to today? Like how big is the defensive equities strategy?
Well, interesting. It's about bit over $1 billion now. So it's a reasonable size fund. We still are talking to people, explaining to them what defensive equities are. Like it's a very underpopulated area of the market, but we do find people when they hear about it, some people are very interested. So we're still trying to get the message out. In other markets, globally, there are more people playing in this space. In Australia, there's a lot less people playing in the defensive equities space. How has it evolved? I think the big thing that we've gotten better at over time is some things look defensive, then they become undefensive. We call it a defensive trap sort of thing. Okay. I think we've got better at working out when to knock something out because it's a defensive trap. And back to supermarkets we talked about before, I'm not saying this is a perfect play out or anything like that, but there was this big government inquiry coming out in February. You don't know what's going to happen. So you kind of go, well, I own some Coles or some Woolies at that point in time. You might downweight that and get out of the way, let the risk event play out and then get back in. Because we're really just trying to avoid volatile events. I'm not saying I could predict what was going on with the ACCC report. As it turned out, judging from the stock markets, it's relatively benign, but you don't want to wake up and own a stock that's gone down 20, 30%. Yeah, I mean, legal cases are like that, regulatory inquiries. Another classic one for defensive traps is a new customer, a new participant enters a market. I think CoStar buying Domain in the real estate classifieds that's a game changer. REA's got a big competitor now, much tougher competitor. Other defensive traps we kind of keep an eye out for things like short life gold mines. They might move with the gold price and look quite cheap, but actually they're going to run out of gold in 2 years because there's just not much more ore left. I can run through a whole list, but there's you get better at spotting them and picking them out and saying that looks defensive, but it's not. I've got to just move somewhere else.
Well, we want to, I guess, turn to why defensive equities. You said earlier that you were, making the case to advisors out on the road that they should think about this, and I imagine some of the pushback is the idea that defensive equities underperform. Yeah. You've told us that it hasn't, so this is your case. Tell us how much you've beaten the market, and I guess talk to us about like some of the misconceptions or some of the perceptions that you hear from advisors that you just, you wish you could correct.
Yeah, and look, I think we've over 11 years, roughly. I haven't looked today. Markets move around a lot, up about 1% over that time. There'll be fees, all sorts of things. Don't pin me down, but 11 years, and look, it has been a difficult run for defensive equities lately. Right, markets going up linearly tends to be tough, but no, we're still up about 1% over 11 years. I think the case is, I think you can get over anchored on the word defensive. As I said, these stocks grow their earnings over time, right? They grow and they grow steadily. Another way of thinking about it is probably should have put this more in the branding is quality compounders or something like that. Yeah. You're probably more positive than defensive, but just boringly growing through time. And look, I do feel right now it's an interesting time because you look at some of the biggest stocks in Australia. Call out the big four banks. Their earnings outlook for growth is pretty weak right now. If they grow their low single digits over the next 3 years, that'll be a great outcome. Cross your fingers. Hope that happens, right? So we're not the competition for defensive equities right now. I think is pretty weak, right? Like we're going to get some nice earnings growth, be looking much better in 3 years, and some of the big parts of the market we're not participating in. We own no banks. They're not going anywhere, right? They're going to have the same earnings in 3 years, give or take, that they do now.
We want to pick your brain on the banks a little bit later, so let's put a pin in that. Yeah. I guess earlier you said your goal when you were coming up with the strategy was only suffer 50% of the falls, but take 80% of the gains. Yeah. 11 years in, would you give yourself a pass mark on that?
On average, yes.
Okay, nice.
We actually do monitor this, as you would expect. We're kind of obsessive about monitoring our up and down capture, and I won't bore you. My sales team or something. Could you stop talking to me about this? Why you monitor? But we do manage that, and like with all things in equities, any given month, any given day is not going to work. But if you can get that right on average over quarters and years, you'll be fine. And the numbers are we've done a little bit better. We've got about a little bit more on the up and a little bit better on the down. But we're talking single within 1% or 2%. Right? So you tend to land it over time. Yeah. We spend a lot of time managing that risk.
So Hamish, Alex just put a pin in the banks. So let's take the pin out and dig a little deeper. I think a lot of us and a lot of advisors might think of banks as a classic defensive play. Yeah. Is that the case? Like, how do you think about the Australian banks?
Having been in equities for 20 years and worked in banks for 30 odd, thinking of banks as defensive is a real mindset shift for me. Like, I think it's a very temporary thing. I mean, when things get bad, banks tend to wear it more than anything else. They tend to be the ultimate cyclical stock if you look at COVID and global financial crisis and things like this. Right now, they're having a moment in the sun, but I don't think of them as defensive. In fact, I think of them as quite expensive right now. If I could sort of talk about why I think they've done well, because they've been everyone's talking about why is CBA the most expensive bank in the world.
Yeah, CBA is the ultimate growth stock.
Ironic, and look, I'm not in any. I'm not being critical of these companies. I think CBA is an extremely well run company, but I don't want to pay, the most expensive. I mean, it is a slightly less attractive company from return metrics as JP Morgan, and you pay double the price for it. It's sort of like mind blowing. And there's a couple of things that have kicked this off, but I think the big one is, frankly, some of the big super funds. They publish their data every 6 months. You know exactly what they hold. They have to disclose it, and it's in files. If you laid them out in this room, it'd be longer than the room. It's like 3 meters long. But you can tell exactly how many shares of CBA, for example, they've bought in a half, and you can weigh that up versus the total assets they have and the total equities. And are they allocating to equities? Are they allocating to CBA? And you can see in the December half, for example, for every dollar of inflows, that if they were going to put $1 into CBA from inflows, they bought 11. Like, for some reason, even though CBA is the most expensive stock in the market, to my mind and to many people's mind, for reasons beknownst to them and we can speculate, they decided to buy even more CBA, right? And there are reasons. They're trying to get into growth, equity. So some people made that decision. Some people have been underweight. It's just hurt them terribly. The interesting thing is, after doing this for CBA going up for 18 months, and them buying a whole bunch, their underweight's the same, right? And I sort of get in the concept of underweights and overweights, but if you have an underweight to a stock and it goes up, your underweight gets bigger. You've got to buy more stock to keep the underweight. So I think one of the big drivers for the big super funds is they've got risk limits and they keep hitting the risk limit, so they keep buying. So the stock cross is going up.
Oh, yeah.
Is it to infinity and beyond? Do we sort of like Buzz Lightyear up to $1 billion? I don't. It goes the other way as well, right?
Yeah.
Like the cycle goes the other way. But I think that you can see this in the data. It's a very clear pattern. Yeah.
If the super funds are still underweight and all the active managers are avoiding or shorting, who's buying? Is it just passive?
Well, the super funds are buying to maintain their underweight. A lot of them. And look, what's interesting is who's selling, right? Like retail. The big four banks release their share registers, who owns them in 3 categories. It's like retail, institutional, domestic, institutional, foreign. For years, it was a truism, retail doesn't sell banks. Until 18 months ago. Retail have sold about 10% of their holding of bank shares in the last 18 months, right? They've just looked at it and gone, CBA, 2.8% dividend yield, CBA term deposit, 5.5%.
Yeah.
I'm going over there with my money, just like I need income, I can take this. So it's been interesting. Retail are the ones leaving, and domestic institutions, which include super, is buying.
Are the ones buying. Yeah, right. Okay.
Wow. Yeah.
So let's zoom out from banks and just talk about the Aussie market as a whole, because we're doing some research before this interview, and we saw that your view on the overall Australian market was that it looks expensive.
Yeah.
So I guess, I imagine as a defensive equities investor, when you start seeing things look expensive and you start thinking maybe the top will come off and maybe this is my time to shine. Is that how you're thinking? How do you position the portfolio?
Yeah. Well, it's a good point. Look, we don't try and time the market. We try and maintain a pretty constant position through, because I'm not here to tell you I can time the market. In fact, I'm pretty here to tell you I can't, right? So I try and maintain a pretty constant posture on the way through.
Yeah.
Get my 80 and get my 50. But to justify it's expensive, I think if you look at the PE, the forward PE of the market is about as high as it's ever been, right? I think it's just sort of easy maths to do. But what I find encouraging within that, it's very narrow. Like if you take out the big four banks, Wesfarmers, Goodman and Macquarie, it's 7 stocks. But that 7 stocks is like a third of the market. They're very expensive on PE. You take those out, the rest of the market kind of looks about average, like it doesn't look expensive or cheap. It just and then within that, you've got a nice distribution. So I think there's plenty of room. There's plenty of sort of room in the pond to fish, but just kind of steer clear of some of the really expensive ones. And sort of to that end, I think buying an index fund right now. I mean, I'm an active manager. I'm never going to make the argument to buy an index fund, right? But like right now, I think there's like quite a lot of concentration. Those sort of 33% of the market, you're paying a lot, right? Yeah. Just be a little bit active at the moment and just avoid some of those ones.
So where are you seeing the opportunity then? If it's not sort of top 7.
Yeah.
Like where are you finding that you're landing?
Yeah. Well, interestingly, we hold about 65 stocks. So we're part of the, there's no free lunch in being 80 or 50 in the market, but the one free lunch in investing is diversification, right? That is the only free lunch I think that really sort of exists. So we are quite diverse. But if you look at our larger holdings, I talked about Coles, talked about Medibank, Woolworths is getting there. They've copped a few, but they're looking at Metcash. So supermarkets generally quite attractive.
Yeah.
With respect to mining, we are not overweight, but we're not materially underweight mining. So that's kind of relative to the banks attractive. So that's some of the spaces. But then we have a very diverse range of so diversification. We don't want to be thematically exposed. I mean, we're long gold, right, for example, but we're not thematically exposed to too many things. In fact, we try and spend a lot of time taking themes out of the portfolio and getting real diversification. So if one thing goes wrong, well, hopefully it won't affect all the other things.
So I imagine you were speaking earlier about defensive traps. The 7 stocks you listed earlier, I imagine they all fit in the definition of defensive traps at the moment?
Well, I don't think they're defensive.
Oh,
right?
yeah,
so
fair. Okay,
interestingly, they don't. When we look at them, they don't screen cheap. They screen really expensive. And actually, historically, they've been incredibly volatile, right? Like, banks you'll wake up in the morning saying, oh my God, what happened there, right? Whereas part of the reason they've done well is they have had a sweet spot. What kicked them off in 23, bit of credit growth, bad debts kept on coming down, margins, rising rate environment's kind of positive for them. And interestingly, you look around the rest of the market. So if you looked at, say, the year to 2024, most people had slight earnings downgrades, but banks had slight earnings upgrades. And they were expensive, but they weren't getting downgraded. And so there's almost a bit of people overvalue the direction and undervalue the absolute position that went on. So I think that's sort of what got them into that let's buy them position. I think that the difficult thing is that you look forward, bad debts can't get below 0. Well, I mean, they can technically. You can write back stuff you thought, but we're getting into sort of esoteric accounting here. And margins are rates coming down makes a tougher rate environment for margins. So like all of the things that kind of helped them in their sweet spot for a while roll the other way. The other thing I get told was, well, isn't credit growth going to help them? Because credit growth is quite strong. And my response to that is, we've had great credit growth for 3 years in Australian banking, and their earnings has gone nowhere. So every year I'm putting in, say, credit growth of 6% 3 years in a row, I'm putting in 6% more capital every year, but I'm not growing my earnings. So my return on capital is just going down and down and down and down. And let's say earnings starts to go down, well, then we're really in a tough spot. So I'm not. It's been fascinating to watch the strong credit growth turn into no earnings growth. I think that's interesting to consider when you think things are about as good as they can get. This is the good case.
Yeah,
right? This is the good times.
Interesting. Yeah.
Right? So.
And just a quick follow-up on one of the other 7, Wesfarmers.
Oh, yeah. Right.
Yeah.
Sorry, I got stuck in there.
No, that's all right. That's all right. So that doesn't fit the defensive characteristics.
No, look, it has it. Look, we will hold any stock at any time if we like it. So we've held the banks in the past. We've held Wesfarmers in the past. And once again, not a criticism of Wesfarmers, very well-run company, doing a lot of really good things. Bunnings is a wonderful business, and what they've done with Kmart and Anko is truly excellent execution. World class, but just the multiple.
Yeah.
Right? If you look at most people's earnings for what they thought Wesfarmers was going to earn over the next 3 or 4 years, including us, they haven't moved much over the last 18 months. Stock price is 50% more. So my privilege is to pay 50% more for something that isn't actually any better than I thought it was 18 months ago. No, it's not gonna do it.
Yeah.
We're a very well run company.
So it's been a pretty noisy year, particularly with the macro. Some of the major themes, obviously US tariffs, we've seen wars, we've seen the rise of China, persistent inflation, you name it. 2025 has had it. How much weight do you put on, I guess, these big macro themes? And then how are you seeing some of those big global ones flow through into the Aussie market?
Yeah, well, look, don't try and time the market. One of the things we've really learned is trying to pick macro is a bad idea, right? People tend to get it wrong. We're not any better than they are. So just maintain a constant posture, and on average, you'll work it out. But in terms of the volatility, I totally agree with you, right? Like if you go back historically and look at the last sort of 80 years of stock market performance, what are the things that have made the stock market go down more than 20%? Wars, inflation outbreaks, debt moving up really quickly, technical hits like tariffs, like all of the tick a box, right? Like you look at everything, it's all there, but the market just kind of plows on through, right? And so the trick is you don't want to predict any of these things are going to happen, because if you'd use history as a guide, you would have been dead wrong for the last 2 or 3 years. But it does feel like the risks are very elevated, right? Like we're sitting here, any one of those risks we talk could just sort of spiral into a new place and cause severe problems. But I think there's certain people who measure these things FOMO market, right? It's like how much exuberance is out there? Are people levering into the market? Where's short interest at? What are investor surveys saying? A lot of those things are saying we're kind of in FOMO territory, right? Which is all my friends are doing well, I better get in kind of territory, as opposed to I fundamentally think everything's great. We're kind of in the emotional stage of the bull market.
Yeah.
It's crazy.
I still don't think we're at 2021 FOMO levels.
Feel like
that was next level.
Buy anything. Right?
Literally.
Buy anything's gone up.
Buy digital images, call them NFTs. That'll be a top signal.
That's right.
So obviously, you don't try and predict the market, the direction of the market, but I guess in terms of what factors you're thinking are going to be most important, if you look out 12, 18 months, what are the most important things that you think that we should all be watching?
Look, I think particularly in Australia, China's macro policy matters a lot, right? It can, we're a big sort of output of the Chinese economy. So if they are currently in a fairly defensive posture, non-stimulatory posture, if they decide to change, that's huge for Australia. And I just sort of take you back to sort of 2022, at the beginning of 2022, every expert in the world, every China watcher was saying China is not going to open up to COVID and they will never let their housing market fall over. Fast forward to the end of 2022, they've done both of those things. So I think China is unpredictable. They are managing their own goals. I think our ability to understand what their goals are and what they're going to do to achieve them, I think picking it's a tough game, so we're not going to do it. But if they do decide to move, that's dramatic. And I sort of, the other thing I'd call out, if you look back to the last week of September 2024, Chinese leadership kind of created an impression they might stimulate. You look at that week, every mining stock in Australia went up 15%. Right? And then it probably went down again when they sort of clarified, no, we didn't mean that. But that's the kind of impact that Chinese stimulus can have on Australian markets. So I think that's definitely one to watch out for, but I'm not making a prediction because I think it's hard. But as I said, we're kind of neutral weight on iron ore. We're not, and mining. We're not taking a risk on that because we just don't know. I think US inflation, US mortgage rates are huge for the world. What happens to the US economy in terms of monetary policy matters a lot. If you look at the most recent earnings season in the US and here, like anything that's interest rate dependent on the US, so like James Hardie, anything in building materials, just got killed, right? Housing turnover is very low in Australia because it's too expensive to borrow. You can't sell. Your interest rates are too punishing. So US inflation and mortgage rates, driving the biggest economy is going to matter a lot to us. And then there's the things you ticked off before, like there's a couple of pretty serious military confrontations going on. We hope they all get resolved as best they possibly can, but there's always a risk that they don't.
Well, Hamish, we're going to take a quick break and on the other side talk about some practical ways that advisors can implement defensive equities into their portfolio. We'll be right back.
A massive thank you to SIBO for supporting this episode. Here's something you may not know. Australia actually has more than one stock exchange. And if you've ever bought an ETF, there's a good chance you've already traded on SIBO Australia without even realizing it.
In fact, around 40% of all ETF trading in Australia happens on SIBO. It's clear that they're right in step with the growing interest in ETFs among Australian investors.
So next time you're investing, keep an eye out. You might be trading on SIBO again.
Welcome back to Basis Points. We are talking all things defensive equities with Hamish from AllianceBernstein. And before the break, we were talking about the opportunities in the market. But let's talk about how advisors can practically implement them, Hamish.
Yeah.
What should advisors be thinking about when constructing resilient sort of client portfolios?
Yeah. Look, I feel right. That answer can move over time. I feel the answer right now is some of what I talked about with the narrow market, right? There are some very expensive stocks priced for perfection right now. So I think when you're thinking about resilience, you want to be a little bit cautious about things that are a bit fragile, right? Price for perfection. So I think that's the biggest one right now. And it's a pretty easy one to do. You just don't have to own 6-7 stocks and you've largely neutralised that risk, right? So I think that's my number one right now. Yeah.
Nice. Don't own top 7.
Yeah. Well, yeah, it's just not all the top 7, but the banks, Macquarie, Goodmans, and Wesseys. I think that's kind of it's a good broad sample to keep you out of price for perfection territory. Yeah.
Nice.
So for advisors who are interested in this idea, only taking 50% of the loss and keeping 80% of the gain, that math seems to work over time. How would you recommend they approach this conversation with clients?
Yeah, well, but it's interesting. I having spent a lot of time with a lot of advisors over the years, I realised that being a financial planner is a lot of technical skills, but you're also a psychiatrist as well, right? I think all the planners are pretty good at working out the risk appetite of their client and what they're going to be and what they say they'll do, but what they'll really do, right? And so it's really, I think they'll know, right? I think the good planners will know this client, they're going to be the one when the market drops who's going to be on the phone calling me. They don't have an appetite to tolerate that. Whereas they'll know other clients that they have, like, risk up, get me into it, let's go. You know, they'll know, but they'll be part of their risk assessment and their client assessment and all of the kind of subtle things that they're looking for when they're doing those preliminary interviews with people. Yeah.
So when deciding which defensive equity manager to choose, what questions should advisors be asking when trying to evaluate the difference between strategies and which manager to go with?
Yeah, well, I mean, obviously I'm going to give you a list of things that lead directly to us, but I think, you know, in all seriousness, I think, look, I said it's a relatively underpopulated space in Australia. There aren't, if you want to do defensive equities, there are not many people who do what we do. But I think within that, you know, if you're thinking peace of mind is what you're after here, and we have kind of a long track record, which is beneficial. We've sort of been through a few cycles. You can kind of see what it's going to look like. We're part of a very large global company, so we're sort of backed by some, you know, serious capital. And, you know, there's a lot of risk management that comes with being part of a big global company as well. You know, we're constantly, you know, dealing with doing everything the right way. You know, we've got a big reputation to manage. We need to make sure everything is done properly. So I think to some extent, if you're looking for peace of mind, a big long track record manager is a nice sort of addition to a peace of mind product. Yeah.
I imagine another thing you would be advising advisors to do is when they're looking at the strategies and the managers is if you saw any of those 7 stocks that you've called out in the top holdings, you would be saying that's probably not a defensive manager to go with.
True. Look, there's degrees of everything. I don't want to be sort of, I mean, we are absolutely not in any of those, but you can have a defensive tilt or you can be more defensive. So someone who wanted to be defensive but less defensive than us might hold some of them. So I don't want to be too absolutist about it all. And I think also, I mean, you know, a lot of financial plans will have some defensive equities and some, you know, there'll be a mix of different strategies to sort of ride through the cycle. So, because, you know, you can't pick it to some extent, right? So I don't want to be too absolutist, but I kind of want to clearly say we are who we are. And if you want that, that's what we do. Yeah.
So if we close, going back to the inception of the fund, the idea was, you know, to create a product that would help clients ride out the volatility of the market and perhaps protect them from some of their own worst impulses to sell at the absolute worst time. If you could leave advisors with one key takeaway to help manage their clients' behavioral pitfalls, to help them manage through the cycle, what piece of advice would you leave them with? Yeah,
well, look, it's one thing. I'm sort of playing back to advisors what they've told me, right? Because, you know, it's a different job. I deal with a lot of advisors. The more I talk to them, the more I realize I don't know, right? You know, so it's why I have an advisor, right? I don't pretend that I know what they know. But, I think the one thing I hear a lot is, the phone rings a lot more when the market goes down, right?
Yeah.
Like when the market goes up, everyone's fine. And, but when it goes down, that's when things get hot. What can you do to kind of make that an easier ride for you and your clients? What can you do to sort of soften that blow, which is kind of the genesis of the strategy, right? Stop the phone ringing, kind of make people feel more comfortable when things are tough. Because the right thing to do often, not always, I don't want to give advice, but the right thing often to do is just stick it out, right?
Yeah.
So,
I still remember in Liberation Day, we get a couple of advisor emails just from, the people that we meet. One of them started their email with a stoicism quote at the top, and I was like, "Oh no, we know things are bad when we're pulling out, the ancient Greek philosopher quotes to start things off."
Well, it stood the test of time.
Right?
Still quoting it 3,000 years later or 2,500 years later, it's probably got some resilience.
If we can get in some products that avoid needing to pull out those quotes, that's probably a win.
Well, the difficult thing about life is in the world, things move around, right?
Yeah, they do.
The same patterns repeat themselves over time.
Yeah. Well, look, Hamish, we really appreciate you jumping on Basis Points today and explaining the strategy. And we'll include links in the show notes if advisors want to learn more and talk to their clients about it.
Okay. Well, thanks very much for having me. Appreciate it.
Thanks, Hamish.